Welcome, you're watching Money 9. I'm Sakshi Batra. Well, there is absolutely nothing stopping the bulls at the moment. So what should you be doing as an investor at this point? Should you be really booking your profits at this point? Or should you be going aggressive with the market that is not stopping right here, even at the record levels that we are seeing? We'll discuss all about markets and what are experts really making sense of with a very special guest. Joining in, I have with me Mr. N. Jayakumar, who is the MD of Prime Securities on this edition of Market Masterclass. Well, thank you so much, Mr. Jayakumar, for taking out time for Money 9 and being with us on this show. Let me kickstart by asking you, well, the markets at record high levels have actually surprised everyone on the street, whether it's the market participants, investors, analysts, all of them alike. Now, I wanted to understand a little deeper. While the Nifty has taken a long time to move from, say, 15 to 16,000 kind of levels, it just took about a month to reach the 17,000 mark, and there is no sign of a pullback even now. How would you really react to this data point, and would you say that the next move to, say, 18,000 will also come faster?
Well, I think you can't compare 1,000 point from, say, 10,000 to 11,000 between 16 and 17, because right now was 17 to go to 18, that would be just a 5.5–6% move, whereas at a 10,000 index that would be close to a 10% move for starters. Again, I'm not in the business of predicting, where the index will go. All I think is that there is a serious underpinning of liquidity that's supporting Indian markets. Both in terms of allocation to India, in the context of global liquidity, in the context of global emerging markets, there is money coming through. And two, there is a huge, in a sense, stimulus, if you will, which the government should have put in, that's actually coming from private equity investors in the startup space. Over the last 18 to 24 months, we've received almost 30 to 40 billion US, which is close to 2.5 to 3 lakh crores, which would actually have been the stimulus that the government put in. And this money, while it may have come to the startup space, is actually percolating to various parts of the economy in terms of demand for discretionaries, demand for cars, houses, employment for people, in terms of infrastructure, office demand, etc., etc. So I think there is a huge salutary impact in the economy, and we have been blessed in a sense with this twin inflow of liquidity. And I think it's very fair to say that at almost 1.25 times market cap to GDP that we are at, I think we are at pretty lofty valuations. We are at the moment being blessed by ample liquidity, and that's what's making a lot of the stock pickers look even better, because the stocks are performing in far lesser periods of time than was originally envisaged.
Right.
So I think we need to be cautious. This liquidity scenario could change, I would not say overnight. And if you specifically look at it from the perspective of, let's say, the US Fed, while the purchase of bonds, etc., may reduce, and that pace could get cut down, but what may not happen is an increase in interest rates. So I think they're good for the moment. And even though there is a lower quantum of bonds being bought, my own assessment is that the markets will continue to be blessed by easy liquidity.
Okay, I'm glad that you pointed out all these very important points, which I was coming to any which ways. The market cap to GDP at 13-year high, 122%. And so far, the markets have actually overlooked the kind of lofty valuations that we've existed at. But now, we are seeing slowly most of the triggers that the markets had, they're already behind us. The Q1 earnings are behind us. Now there is again a question of a third wave coming in. So all of those are overhangs, and we still don't know. And just like how you pointed out the US Fed commentary as well, since now you have seen several, times in history that earlier taper tantrums and how they have impacted the markets. I wanted to understand at this point in time, is Indian market in a better position to, see all these kind of shockers and any potential shocks from emanating from the tightening of the policy?
Well, I mean, at these levels, you could almost argue that there's no way to go but down from an index standpoint. There are pockets of valuations in the market because people use relative valuations. So if you look at it from an absolute perspective, what is to say that banks should quote anything over, let's say, 1.5 or 2 times book? But in easy liquidity situations, 3.5 times book or 5 times book, it's not easy to dismiss them and yet the valuation sustained. Today, Bajaj Finance, for instance, probably quotes at 9 to 10 times book.
Yes.
Now, what's to say that that can't correct to 6 or 7? These things can happen. I just think that our own orientation, like market men, has got reoriented with easy money. Add to it the fact that the Indian public, having been at home like a lot of people in the rest of the world, has also taken to investing directly.
Yes.
Number of demat accounts being opened, etc. So there's a certain amount of money chasing money that's happening. The other thing that's happened is people have in this period of time, anybody who invested has made money, because over this period of time, I would not say it was almost as easy as throwing a dart and making money, but in many cases it almost became that. So from that point of view, these folk have decided to continue being in the market. Money that would otherwise have not been in the markets has come through. So the retail Indian commitment to the markets was between 3 and 4%. That I think may have gone up to about 4.5–5% as we speak. And with SIPs etc. coming through, the NFOs or the new fund issuances that come through are at all-time highs for individual mutual funds. So this is a problem of plenty, and I think it could seriously skew valuations before it gets better.
Yeah, okay. And most of these new investors who entered the market, some of them have also seen the brightest of the days, which we've not seen in history. I'm like, such a short time, and you see 100% of a jump in the market also in such a short time. And there is somehow kind of a feeling that I have a Midas touch. Whatever I touch has turned into gold. And the fear now is that this cannot go on endlessly. So what would you advise those investors who have made a lot of money in this time, but at this point in time, just like you say, that it is time to be cautious, because the only way the markets perhaps can go is down?
So the most difficult thing in a bull market is to actually pull out and say this much and no further. That's where need ends and greed begins. But that's a sentiment that, while I might echo it, a lot of people have echoed it, but the reality is that greed and fear are the two most basic underlying themes. And I think that there's a lot of public getting sucked into markets, and we may well have a scenario that you could see the markets move into significantly more overvalued zones also, because in short periods of time we don't know where additional liquidity takes market levels. Most of the FMCG stocks are trading at very high double-digit multiples, with growths in the 2, 3, 4% range. We haven't seen this before. IT stocks are trading at pretty expensive valuations. What could break the party? I think some Fed action which is unexpected. If the rupee were to appreciate, and let's say go down to say 68, 69 levels, could that in a sense spook the party from an IT perspective? Could be one way to look at it. So there are multiple things that can change the thing, but I feel the underlying strengths in infrastructure, for instance, or select NBFCs, those that are far more retail and granular in nature in terms of their portfolio. Metal stocks especially, I think, are at decadal low price earning multiples, decadal low EV/EBITDA multiples. And these are, some of them are quoting at net debt to EBITDA at less than 1. And when that happens, normally multiples expand. In this case, they've been contracting because there's a complete disbelief about the metal space. And I think that's, so if there is few things that have happened, because people have been junking their dirty portfolio, which is coal, iron ore, mining and stuff like that, you are at a scenario where all these assets are being sold down at EV/EBITDAs of 1, 1.5, 2, but coal prices are at multi-year highs, multi-decade highs. So too for iron ore prices are shooting up. The input prices of things like steel have gone up dramatically, and no new capacities are coming up in steel, aluminium, and so on and so forth. So it's difficult to see how these prices will come down. And so the more competitive backward integrated units in India in the steel and aluminium spaces could do exceptionally well, and they're still available at extremely low valuations. I think this combination makes the metal sector, which is actually steeped in pessimism and cynicism, very ripe. That could be one area that people could focus on. The other areas I mentioned to you are select NBFCs. Maybe I think if you look at PSU stocks, the government has shown their hand to divest. Of course, divestments have not happened, strategic divestments at the same pace that you would have liked. My own assessment is that we could be surprised over the next few months as the government really gets down to doing it. I think Air India, BPCL, Concor, these should happen. And when that happens, I think the PSU space could be another area that we could look at as a huge repository of value. And where there is capex also happening, net debt reduction is also happening. So a lot of the good stuff is happening, but it's not being factored.
Yeah. What about the auto space? If the markets are at all-time highs, there's this one space that has underperformed. Now there are several things. Two-wheelers are seeing muted demand. We've seen that happen in the August sales. The passenger vehicle side, of course, is facing the shortage of semiconductors parts. There is obviously the rise in input costs, which is why the number of price hikes that they are undertaking at this point. How should one approach this entire space, given the fact that they are now going to be seeing the festive season play out and perhaps all the hopes are pinned on that?
No, I think the space is being disrupted very aggressively. So other than maybe tractors, which could be a space for some kind of sanity there, but most of the spaces I think are being disrupted. So I think we would look at a scenario where things like ride sharing, people's the next gen doesn't want to own vehicles. People are happy with travel. So and multiple models are emerging, not just Uber and Ola, but a whole bunch of other models are emerging as well, where people are preferring to sort of lease or share vehicles rather than actually own them. My own assessment also on cost side is they're going to be challenged to be able to pass on cost to these to the end users. So unless we are actually having disruptions of that kind, EVs coming in. So for me, it's an avoid right now. Okay. I think there are too many moving parts.
Okay, understood that. What about pharma sector, sir? Of course, this has been one sector that has really benefited in this last one and a half years of COVID-19. Now, there are several parts to it. One is the diagnostic space, which has seen several new entrants also coming in. The other is the hospitals, which have seen continuous, like in the second wave, of course, they were having full capacity going in. Of course, we have the pharma play, like, pure play pharma. But now there are some emerging US, concerns on pricing pressures as well on some of these leading companies there. How does one approach the space? The best place to, put your money right now if you have to play a long-term pharma story?
So I think the generic space still offers a lot of, I think there are short-term pricing pressures, but there are companies that are trading at middling, teens in terms of multiples. These are companies that may have gone through maybe 1 or 2 quarters of slack profits or lower growth, and the markets have punished them instantly. I don't want to name stocks specifically, but there are 2 or 3 stocks in the space that I think especially in the US generic space. Number 2, the diagnostic space we like a lot. The players are ripe for consolidation. Valuations are very, very high. The hospital space has seen a big re-rating. The 2 or 3 big players have got moved up, I would say 2 to 3x over this period of time.
Yes.
So given that, I think we'll probably stay with the pharma space. Again, it's been a big beneficiary, not just of COVID or these conditions, but it has not seen the kind of rise in the last several years which it saw now. And I think there's a bit of a catch-up that happened there.
Right, sir. So I just wanted to ask you a little bit on the IPO space and how this space has really seen a whole lot of frenzy. The kind of money that has been raised in H1 of 2021 is again surprised a lot of investors who've been watching this space. How have you analyzed this entire space? Of course, with the talks of valuations on the one side and no profits on the books is again a debatable topic. But overall, and how do you see that progressing from here? Is the best of IPOs behind us?
I think there's a serious bubble in the IPO space. I think anything is selling right now because people want a piece of the action. The space that excites us, which we as an investment bank have been really focused on, is the early stage financing, where rounds of the pre-Series A and the Series A rounds, where we've raised monies of between 2 crores to 25 crores for various companies in the space, as I mentioned, of pre-Series A and Series A. And that's a space we're very excited about.
Okay, understood. Also, sir, I wanted to take your view on the first-time investors entering the market, say at this juncture. the market has rallied already quite a bit, and we know, of course, this has surprised us in a lot of ways, but we still don't know how much further do we have for the markets to go. But for all those new investors entering, what is the best way to create a wealth generating portfolio at this stage?
It has to be SIPs. There's no take balanced funds, do your monthly SIPs, and keep investing. And actually, paradoxically, hope for a sharp fall in the market so you can average.
Okay, understood. That's all. On that note, I'd like to thank you very much, Mr. Jayakumar, for being with us and sharing all these wonderful insights on the markets and the various aspects that you've spoken about. Always pleasure having you with us. Thank you so much. And with that, we wrap up this edition of Market Masterclass, and we'll keep getting you all such interesting conversations with the market veterans so that you can understand how are they analyzing the markets, and you can also take informed decisions about your investments into equities.